Welcome students. So in the previous lecture we were discussing about the preparation of the financial statements for this particular problem, and I was preparing the profit and loss account. After preparing the trading account, I was preparing the profit and loss account. So we had taken all the items on the debit side of the profit and loss statement, but on the credit side we had not taken anything so far. So now we will be completing the credit side and then we will be calculating the profit or loss. So if we take the credit balances into account, so we have taken almost everything. One correction I would like to advise you here, that we have taken one item, that is the center sales tax. But so center sales tax is, if you look at this item, center sales tax is written that it is payable. So it has not yet been paid, it is payable, so it will not be taken in the profit and loss account, but it will go to the balance sheet and we will show it as a liability in the balance sheet. So we have to remove this item from the profit and loss statement, and then other items are okay. We have taken all the items in the debit side, and now we will be taking the items in the credit side, and then we will be trying to find out the profit or loss before tax and then after tax. So this is the, we are continuing with the profit and loss account. So now I will be coming up here, whatever the total expenses were there we have already taken, and then we will be taking the calculating the profit or loss. So in this case we have to take now the gross profit will come this side. By gross profit that we calculated in the trading account, we will take it to this side, 3,55,530. This is the gross profit. And then let us look for any other item. If there is any other income is there, indirect income is there, just search for it. And premises, no. Plant and machinery, no. Opening inventory, no. Debtors, no. Land, no. Cash in hand, no. Current account, no. Bills receivable, no. Purchase, preliminary expenses, wages, general expenses, salaries, bad debts, interest on loan, nothing. These are all debit items. Income side, if you look at, we have share capital, secured loans, profit and loss, balance, no, nothing is there. Then creditors, sales, general reserves, and center sales tax payable. So it means there is no other income which we can call it as the indirect income. So that is not there. Here we look at the additional information for adjustments. So we have share capital, then we have depreciation, preliminary expenses, interest on term loans, bills receivable, doubtful debts, value of inventory, income tax, and the dividend. So it means there is no other income. So we have taken the income here only as the GP as the income, and then on this side we have to take all the expenses. So it means this is 3,55,530 is the total direct or indirect income, and we have taken all the expenses here. So if you take all the expenses, then we can see that what is the profit before tax. We will have to calculate that profit before tax, and on that we have been given the percentage. So the total items here we will again put 90,338 were the salaries, and then the other balances were there, that is 54,000 was the interest items. Then we have general expenses were 10,252. Then we had depreciation 1,05,380 was the depreciation. Bad debts are 3,165, and then we have 3,000, and then we have 1,500, and then we have I think these are the only preliminary expenses and everything. So we have taken all the items, all the expenses here if we look at. So we will be able to find out that what is the total of the expense side. It is 5, 2, 7, 8, 15, 1, 4, 9, then 8, 17, and 6 is 23, 2, then it is 5, 7, 10, 11, and 5, 16 is 1, 5, then 5, 10, then 17, and then we have to go for the 1, 10, 5, 15, 16. So it is 16 and 1, 1, 2. So it is 2,67,000 and 635. So it is the total of the credit side is 3,55,530 and this is 2,67,635. So now we have to take this, and if we take this, so we are able to find out what is the profit before tax. That will be 5, then it is 9, then it is if we take this is 4, 14, 6, 8, then it is 14, 7, then it is 14, 8, and then it is 87,895. So the profit figure is 87,895 is the profit. So our total of the expense side is, this is the gross profit, and total of the total expenses, but we have written in the previous lecture, the total expenses is 2,67,635, and now the profit, net profit before tax, net profit before tax is 87,895, right. Now we have to calculate that, we have to provide for the provision for the tax. Provision for tax. Now how much provision for tax we have to make? The tax rate is given to us here somewhere. Income tax is 35%. So we have to calculate the 35% of this. So if we take the 35% of this figure, that is 78795 into 35 of this. So this works out as, this tax part works out as provision for income tax, that is 30,763. This is the provision for tax. And now we have to calculate the net profit after tax. So net profit after tax is going to be 57,132. 57,100, so this is the total net profit before tax is this much, then is the provision for tax, then the net profit after tax is 57,002. So if you take this into account, so we will have to count this and this. If we count these three things, 3, 2, 5, 5, 10, 0, and then it is 1, 4 and 4 and 6, 10 and 3, 13. So this will work out as 3,55,530. This is the net profit after tax. So this is the net profit after tax we have calculated for this given problem, and net profit after tax is 57,132. Tax is at the rate of 35% on the net profit before tax, that is 87,895. This profit provision for the tax is at the rate of 35%, 30,763. So now this is the completion of income statement, that is the profit and loss account. Now we will be moving further to prepare the profit and loss. This is, we are going to prepare now profit and loss appropriation account. Profit and loss appropriation account. Profit and loss appropriation account. This account we are preparing for the first time. So profit, same columns, that is the particulars here. We will have the same columns here, particulars, as we are having for the profit and loss account, particulars, then it is amount, this is the debit side, this is again particulars, amount, and this is the credit side. So now we will have to take the profit. So there is given to us that there is the opening balance of the profit. Profit of the previous year is kept open, this is not transferred to the capital, not added into the capital. So the balance of the on 1st April 2015. So we will have to start with here, that is buy balance on 1st April 2015. The balance amount of the profit is, which is open, kept open, we will have to add it to the current year's profit, 39,375. 39,375 is the balance, then by net profit for the year, net profit for the year that we have calculated here, that is 57,132. So this is the total profit we have earned. So this is the total profit, and the total profit works out as it is 7, then it is 10 1, then it is 4, it is 5, then it is 16 6, 1 5 3 8, and it is 9. It is 96,507. It is 96,507 is the profit here. Now we have to make the provisions. Now let us look at that. What are the provisions? General reserve balance is also given to us, so we will have to take this into account. So we will be transferring it to the balance sheet. So from here only. So what are the provisions required to be given? Depreciate, no. Preliminary expenses, interest, bills receivable, doubtful debts, value for inventory, income tax to provide we have done. Board of Directors recommends dividend on preference shares and a dividend preference shares and a dividend of 12% on equity shares after transferring 5% of the net profit to the general reserve. So it is 5% of this will go to general reserve, to general reserve. So general reserve is how much is the profit for the year? 57,132 into 5% of this. So this works out as this. So it means this amount will come out as 2,900 rupees. 2,900 rupees will be the general reserve. This amount 5% we have to create of this particular figure, which is the profit for the current year. This is the profit for the current year, that is 57,132. So 5% of that we have transferred to the general reserve, which works out as 2,900. After that they say that we have to provide for the dividend on the preference and equity shares. So what is the preference shares rate? Preference shares are, say, if you look at the preference capital, it is given to us 10% preference share capital. So this 10% preference share capital means it is 1 lakh. So 10% of the 1 lakh is 10,000 rupees. So preference, now we have to go for the 2 dividend. 2 dividend. So it is preference first. Preference is 10,000 because it is 10%. Rate of the dividend is given to us here. This is the rate of dividend. It is total capital is 1 lakh. So 10% of the 1 lakh is 10,000 rupees preference dividend. Equity dividend. Equity dividend. Equity dividend is at the rate of 12%. So how much is we are going to provide? 36,000. This figure will come as 36,000. 36,000. How we have calculated this 36,000? Because how much is the share capital? If we look at the share capital, equity capital is 3 lakh rupees. So it is 3 lakh rupees, and we are given the percentage here. Here it is given that a dividend of 12% on equity shares means it is a 12% of the equity share capital. We have to provide the dividend, which works out as 36,000. So this is 46,000 rupees is going to be distributed as dividend. And what is the now remaining amount? To surplus to be transferred to surplus to be transferred to balance sheet. And that what is the difference now? It is 48,900. So balance amount is 47,607 is going to be transferred to the balance sheet as a profit of the year. So total profit we had was 57,132. Previous year's profit, which was kept open, not added in the capital in the balance sheet, was 39,375. So total profit we have here is 96,507. Out of this we have transferred 2,900, that is 5% of current year's profit to the general reserve, which works out as 2,900, and then we have paid the dividend, that is 10,000. to the preference shareholders, which is already given specified, and to the equity shareholders the rate is given to us is the 12%, so 36,000. So total amount given as a dividend is 46,000. So this plus this minus this is the balance here, 47,607, and that is transferred to the balance sheet as a net profit to be transferred to the balance sheet. And now this will be added to the balance sheet, transferred to the balance sheet and added in the capital, and this is the total balance going to be available with us, which we will be transferring to the balance sheet. So this way we have completed the profit and loss account, and we have tried to find out that how much is the total profit available with us, and out of this profit we have paid the dividend, and remaining we are going to transfer to the balance sheet. This amount is going to be 47,607. This amount will be 47,607, that is going to be transferred to the balance sheet. So this is the amount which will go to the balance sheet as a surplus profit, which is neither as a kept as a general reserve, nor it is distributed as a dividend, but it is left unused. So it is added into the capital, and the capital will appreciate by this amount. So this is how we prepare the profit and loss account and the profit and loss appropriation account of the public limited companies or the joint stock companies. Now we will move to the next step, learning how to prepare the another important financial statement, that is the balance sheet for Mamta Fashions Limited, and we will take some items in the balance sheet, means whatever the items are required to be taken to the liabilities and the asset side, liabilities and capital and the asset side of the balance sheet, we will be taking and preparing and balancing the balance sheet of this company. So now let us prepare the balance sheet of Mamta Fashion. This is the balance sheet. So learning how to prepare the financial statement is more important, and after that is the analysis of the financial statements. So we will be doing the same thing. So it is the balance sheet of Mamta Fashion Limited as on 31st March 2016. Again, liabilities and capital, and it is amount, it is assets, and it is amount. It is assets and it is amount. So we have been given almost all the items here very clearly. So we will be taking those items, and first we will take the share capital. First we will take the share capital, and first of all, as I told you, now we have to mention all the 5 kinds of share capital in the balance sheet. So first we will be taking the authorized capital. Authorized capital, this is the authorized capital, and authorized capital is how much? It is 1 lakh equity shares, 1 lakh equity shares of rupees 10 each at the rate of rupees 10 per share, and this amount is 10 lakhs. This is 10 lakhs. Then preference shares. Preference capital means preference shares are equity shares at the rate of rupees 10, 1 lakh, and then the 1000 preference shares. We will have to write here 1000 preference shares that is the 1000 preference shares at the rate of rupees 100 each. So, it means this amount works out as 1 lakh. This amount is 1 lakh. So, your total share capital which was authorized is, that is 11 lakhs. So, we have to put a line here, and this is the share capital we are. So, this is the authorized capital. Now, next part of the capital is issued capital, issued, subscribed, called up, and paid up capital, is, we have to now calculate this. So, this is authorized, and then this is the issued, subscribed, called up, and paid up capital is 30,000 equity shares, 30,000 equity shares at the rate of rupees 10 per share. It is 3 lakhs. It is 3 lakhs, and preference shares are 1000. Preference shares at the rate of rupees 100. So, it means it is 1 lakh. Total capital is 4 lakh. So, this capital is of importance to us. Now, this, for the sake of showing, we have shown it here that our authorized capital is 10 plus 1, 11 lakhs total. Out of that, the equity capital has been issued in the market is, that is for 3 lakh rupees, and preference capital has been fully exhausted for 1 lakh rupees. So, total capital which is now being used by the firm, which has been, shares have been issued in the market and the capital has been generated, funds have been generated, that is only 4 lakhs. Apart from that we have to take now the other things, that is reserves and surplus. So, this is the two categories. One is general reserve, and when we take the general reserve as on, that is the opening balance, as on 1st April 2015, that is given to us, 1st April 2015 is already given to us. So, we have to write that. What is that reserve? That figure is given to us. This is the figure of general reserve on 1st April 2015. This is the opening balance, kind of 37,500. 37,500, and then we have created during the year. Created during the year is 2,900, which we have created in the profit and loss account, that we have already created. So, this works out as 37 plus 39, 40,400. So, total general reserve has become now 40,400. This is the total reserve. And the third thing is, that is the profit and loss account, or the profit and loss balance. This is, how much was that figure? That is 47,607 rupees. So, now the total capital at the end of 2016 of this firm has become, their share capital was 4 lakhs, then their general reserves became 40,400, and now the profit transfer to the capital is, or to the balance sheet and then to the capital is 47,607. These are the total, if you sum it up, this becomes the total capital available with the firm, and with this total capital now the firm is doing the business, maybe in the 16 as well as in the future years. After this, we will have to add the other items here in this balance sheet, and once we have completed the share capital part, after that we will be considering now the loans, long term loans or the fixed liabilities. Long term loans, we will be taking long term loans, then we will see that is there any other source of funding they are using, and if they are not using, then we will come down, we will take into account the short term sources of the funds, spontaneous finance means all the current liabilities, and then the this liability and the capital sides will be complete, and then we will move to the asset side, and this all we will be doing in the next part of discussion. Thank you very much.